And joining us now in New York, New York, Henny Sender, Chief Correspondent in International Finance at the Financial Times. Henny, it's good to see you again. How are you tonight?
My pleasure to be here.
Terrific. Let me just, before we begin our discussion, share with our viewers the so-called Eurozone deal. Here are the main points for what has the attempt, anyway, been to stabilize the situation. First of all, the EU has created a $60 billion stabilization fund so it can quickly send money to Eurozone countries in financial trouble. It will also create what they're calling a special purpose vehicle to raise 440 billion euros on the markets in order to ensure investors that it's got plenty of money to deal with future shocks. And finally, the International Monetary Fund, the IMF, will match every 2 euros raised by the EU with 1 euro of its own for a total up to 250 billion. And all this comes to a total of about 750 billion euros, or about 1 trillion US dollars. Now let's start there. Why, Henny, did the European Union feel that it needed to pony up so much money in the wake of this crisis in Greece?
The harsh answer would be because they waited so long. Had they acted earlier, they probably wouldn't have had to come up with such a massive program. And even though we think it's massive, and many New York Fed people are referring to it as shock and awe, it's not clear that the markets are either shocked or awed.
Well, it actually seems pretty clear that they're not, because the euro fell to a 4-year low against the U.S. buck today. So I presume this is not having the impact the markets would like it to be having?
It is not having the impact. It is late in the day. Had they come up with this program even 2 weeks ago, I think it would have gotten a lot more warm and effective of a response. At the moment, you know, I do think that there is a large danger that it will be seen to be insufficient because the markets are so skeptical.
Well, if 750 billion euros isn't enough, what more can European finance ministers do to impress the markets that they mean business?
It is very hard for them. You know, part of the condition of extending a hand and a wallet is terrible fiscal austerity. And many people question whether that is a wise quid pro quo. So many people say, we don't know the details of this plan. We don't know if this is even the definitive plan. And, you know, you better come up with more to impress us. I mean, obviously, American investors are not the most significant holders of Eurozone debt, but every single major investment house that I talk to says, we're on hold. We don't know enough. We think the downside is so overwhelming. I think very few people think the end game is anything but Greek restructuring. The
German Chancellor Angela Merkel has said that the bailout has bought time, but not a solution. So if this isn't the solution, what is the solution?
Well, it's not clear, and it's not even clear how much time they have bought. If people indeed expect a Greek restructuring, Greek is considered the first domino. It's a lot easier to fix the first than the second or the third. You know, then battle weariness sets in. The amounts of money become so much bigger. I mean, Italy is almost 1.2, so 5 times the size of the Greek debt problem. Spain, 4 times. So people aren't convinced that this whole thing is the definitive answer.
Okay.
And the markets are going to take it further, I think.
Sure.
They're testing these governments.
Let's focus on that first domino that you talked about, Greece. And the EU has, you know, they've got Greece to agree to drastically reduce government spending, to raise taxes. It's the austerity program that you talked about earlier. There have been riots in the streets as a result. There have been people who have died as a result. Given all of this, how likely do you think it is that the Greek government is actually going to follow through on what it has said it will do?
Well, not only are there questions about whether it will follow through, there are a lot of questions about whether it even should follow through. I mean, other countries make a habit of defaulting on their debt on a regular basis, like Argentina. At some point, you say, should we really put our people through this pain? For what?
Well, for what? Is to make this financial problem go away? Do they not see that as the potential pot of gold at the end of the rainbow?
Well, a lot of people say, that this package was designed less to save Greece than to save the French and German banks, who are lenders to Greece and other of the so-called peripheral European countries. And that is why Greece can well ask the question, what are we doing this for?
Well, all right, you've touched on the next place I wanted to go, which is that if Greece doesn't, in fact, do what it has said it will do, how could that affect the rest of the European economy?
Well, obviously, you will see a great differentiation between those countries that are seen to be solvent, seen to be liquid, can honor their debts, and those who will suffer from the Greek contagion. So we see this great differentiation setting in, I think.
This next question, I guess, is as much political as it is financial, but the spending and the runaway spending, I guess, and the debt in a few countries in the European Union has, I guess, in some people's minds, called into question the entire concept of this entire union. Do you think it's done that?
I absolutely think it's done that. I mean, we've seen the conflicts when you have one currency, but you don't have a centralized fiscal authority. And every government is sort of making up its own rules and not following the rules that everyone has agreed on. I think it's natural to question it. And you read, these financial reports, and all of a sudden, isn't the UK in a great situation because they have they have the freedom to print money and inflate their way out. All the things that you used to think were taboo. So the world has really questioned all its conventional wisdoms and platitudes.
Well, do you like Paul Krugman, Henny?
I have mixed feelings.
Okay, let me see what you have to say about this. He wrote this May 13th, New York Times. If Greece still had its own currency, and it follows up on what you were just saying, if Greece still had its own currency, it could restore competitiveness through devaluation. But since it doesn't, and since leaving the euro is still considered unthinkable, Greece faces years of grinding deflation and low or zero economic growth. So the only way to reduce deficits is through savage budget cuts, and investors are skeptical about whether those cuts will actually happen. It's worth noting, by the way, that Britain, which is in worse fiscal shape than we are, but which, unlike Greece, hasn't adopted the euro, remains able to borrow at fairly low interest rates. Having your own currency, it seems, makes a big difference. Okay, you said you like Paul Krugman sometimes, but not other times. Do you like him in this case?
I totally agree with him in this case. I expect, though, that a lot of hedge funds are going to be testing the new government's commitment to fiscal discipline in the next few weeks. And this government has very short time span to get its fiscal credibility together. And if it doesn't, I do think that the pound might find itself under attack. Having said that, though, one of the great things that the UK did, that the Bank of England did, was lengthen the maturity of its debt. So it doesn't have a whole lot of short-term debt. And that gives it the luxury of even more time.
Okay, given the theory that you and Paul Krugman have advanced here then, how likely is it that a rethink of how much each country can have its own economic policy might take place within the Eurozone?
Well, everybody is asking that question right now. Everyone is doing their own calculations of the benefits and the drawbacks of this system. But I think that people who were always Eurosceptics are going around saying, told you so. I mean, I was living in Hong Kong when the euro came into being, and the head of the HKMA, which is essentially Hong Kong Central Bank, was always saying, I'd rather hold Deutschmarks today than euros tomorrow. And I think, that kind of skepticism has been totally vindicated. So
are we looking towards a likely more centralized or less centralized European Union as a result of the events of the last few weeks?
That's a great question. For this thing to work, you've got to have more centralization, but at the same time, there's so many more people who are saying this is a disaster. And wasn't the UK smart to opt out of this system?
Okay.
And in the end, why did it take so long for us to see all these downsides, which look so inevitable today?
Have you got a speculative answer to that question about why it did take so long?
Well, some people would say, including some bankers, that if the European Central Bank had moved more quickly, if the Germans had moved more quickly, and I mean months ago rather than days ago, this whole thing would never have happened. So you still have different views on it, but I tend to be more sympathetic with those who say, you know, it was inevitable, and the fact that Greece, you know, was seen to cheat on its numbers and therefore spooked the market really was inevitable even without that catalyst.
Okay, let's take the last couple of minutes of our conversation here before we join the others and talk about the impact on this side of the pond. How vulnerable do you think the North American economy is given all of these problems in Europe today?
That, I think, is the most interesting question. My own feeling is there's primary effects and secondary effects, first round effects and later effects. First round effects, we seem to be the beneficiary. We see capital inflows coming here, treasury yields are down, we can keep our interest rates low because no one is spooked about the dollar. So first round effects seem to be very benign. It's the second round effects that will cause problems. For example, European banks rely a lot on funding in the U.S. markets. They account for 30% of the U.S. commercial paper market. You know, as the jitters increase about European banks, they extend to all banks. You could see U.S. banks' funding costs go up. People starting to question, well, which U.S. banks have exposures. I think the second round effects are a lot more uncertain. And then, of course, is the whole question of what a cheap euro does to undermine the competitiveness of U.S. companies exporting to Europe and competing with the U.S. for third markets in Asia. And I think the second round effects are a lot less benign.
Okay, let me follow up on the first part of your answer there, which is, do we have a good sense of how exposed North American banks are to this European debt crisis?
Well, obviously, the overwhelming amount of European debt is in European banks, European insurance companies. But if European banks' funding costs rise in this market, probably the funding costs for all banks are going to rise in this market at a time when banks are already looking at lower profitability because of the financial reforms that we will be discussing soon.